All right, hey, trust you are doing well. Wanted to just share a brief update with you here with respect to the inflation and Federal Reserve. I know everybody, if you've been paying attention to macroeconomic factors, those data points came in last week. I was out on a family vacation, just spending some time with the family, kind of recharging the batteries. Actually had a great opportunity to meet with another business associate while we were out there on vacation in California. But so let's talk about, inflation came in 3.3%, a little bit lower than the projected target or thought process, and or the month before at 3.4%. That was a positive reaction. The Fed had their meeting last week where they remained unchanged on rates. They further gave guidance that they would be looking to have one rate cut this year. That's down from their thought of 3 rate cuts in March. And again, if you look back at what we've been talking about since the beginning of the year, we've said higher for longer. And what does that mean? I would expect, unless we get really some continued data, it's probably going to be tough for the Fed to even do one rate cut this year, even at the September meeting. So again, next meeting is in July. Again, they will likely, keep rates the same. We need to continue to track and monitor that with respect to what's going on with inflation. So now, again, we talk about this. What does that mean for you and I? It means that, rates are not likely to come down at this point in time. And people's over-desire expectation for rates to come down, if you remember back to the beginning of the year, people were thinking for, 3 to 5 rate cuts this year, rates to go down by a point, that to begin starting in March. Some people in a real way were starting to take actions based on that thought, and those were premature actions. Now, again, what I would suggest the better thing to do is to plan for rates to be higher for longer and takes actions accordingly. We're working on a number of projects right now that we're refinancing to lower rates and lock in stability of the rate at that time, give us an opportunity with those projects to, cut interest costs there by probably 25%, which is a good thing. Our rate's going to potentially go down? Yes, but when is that? It's going to be some time. And so, we've looked at the math on that, and it's a better calculus to go ahead and do it now, take advantage of that so that we're, positioning to sell the property, call it in 2 years, and take advantage of the opportunity that we believe is ahead of us. So I just encourage you in your business, in your planning, in your investment, factor in and think about that rates are going to be higher for longer. I would also suggest that we're in an environment where we're probably going to see over the next decade a more higher prolonged rate process. What I mean by that is if you have a thought and an expectation that rates are going to go back down to near zero, I would suggest that's probably not going to be the case. We talked about that before in the neutral rate video, which you can look up and find as well from our past videos. And so again, I think it's important at this moment in time to have a conservative thought process and a focus on those things, because that's really going to be reality. At our best day, we get one rate cut this year. I doubt that'll be the case. And then next year, we begin to see rates moderate. Now, those things could change with respect to some of the damages that we may see in the economy or in the banking sector. And, what the banks are doing right now, many regional banks are taking shared risk with hedge funds in the form of offloading some of the risk profile of their commercial loans to the hedge funds by bringing money in, selling that risk profile to them so that they're better in turn preparing their balance sheet for the year-end reviews, which will help some banks be ahead of the curve of having less financial instability. So that's already happening now. Some of those hedge funds are getting targeted returns in the 15% return tranche is what the expected returns, call it 13 to 15 for this type of debt investment that they're making. So that will, also help stave off some of the bank problems that we saw, earlier in the year and or last year. So, but these are things that we need to continue to watch. Things can change, and then when they change, they can change rapidly. But so I think at this moment in time, I would recommend that expectation continue to be holding that rates are going to be higher for longer. Have a blessed and victorious week, for this is the week God has ordained for you.